In 2005, a chain of American department stores called Mervyn's was still breathing. It had 400 locations, tens of thousands of employees, a 100-year legacy stitched into the fabric of middle-class retail. Then a group of private equity firms, Cerberus Capital Management, Sun Capital Partners, and Luber Adler, bought the company for roughly $1.2 billion. Within 3 years, Mervyn's was dead. The stores shuttered, the employees scattered, the pension obligations abandoned, and the private equity firms, they walked away with hundreds of millions in profit, extracted before the company even reached the grave. This is not an anomaly. It is the playbook. Private equity has become one of the most powerful forces in the modern economy, controlling everything from hospitals to pet stores, from newspapers to nursing homes. And yet most people have never heard of the firms pulling the strings. They operate in the background, behind layers of legal architecture and financial jargon, doing something remarkably simple. They buy companies with borrowed money, extract as much value as possible, and leave someone else to deal with the wreckage. This is the story of how that playbook works, step by step, dollar by dollar, and why the people who lose are almost never the ones who made the bet. To understand the private equity playbook, you first need to understand what private equity actually is, because the name itself is designed to sound boring. A private equity firm raises money from large investors, pension funds, university endowments, sovereign wealth funds, and ultra-wealthy individuals. This pool of money is called a fund. The firm then uses that fund to buy companies, usually ones that are privately held or publicly traded, but taken private after acquisition. But here is the critical detail most people miss. The firm does not use its own money to buy these companies. Not entirely. In a typical deal, the private equity firm puts up only 20 to 30% of the purchase price. The remaining 70 to 80% is borrowed, debt placed not on the firm's books, but on the books of the company being acquired. Imagine buying a house, but instead of you taking the mortgage, the house itself takes the mortgage. If the investment works out, you collect the profits. If it collapses, the house bears the debt. You walk away clean. This is the foundation of the leveraged buyout, the core mechanism of private equity, and it is perfectly legal. The entire industry is built on the principle that debt is not a burden to carry, but a weapon to deploy. Let's walk through a leveraged buyout step by step. A private equity firm identifies a target, say a mid-size grocery chain generating steady revenue. The company is valued at $1 billion. The firm raises $300 million from its investors and borrows the remaining $700 million from banks and bond markets. It then acquires the company. Now, who owes that $700 million? Not the private equity firm. The grocery chain does. Overnight, a company that may have been debt-free is now saddled with hundreds of millions in obligations, interest payments, covenants, repayment schedules. The firm installs its own management team. Costs are slashed, headcount is reduced, supplier contracts are renegotiated, store leases are restructured. Every decision is oriented toward one goal: generating enough cash flow to service the debt and return capital to the fund's investors as quickly as possible. If the firm can increase the company's earnings, or even just maintain them while paying down debt, the equity value rises. When the firm eventually sells the company, it collects a return that far exceeds its original investment. A 30% equity stake, leveraged correctly, can produce returns of 3 or 4 times the initial capital. But if the plan fails, if revenue dips, if interest rates rise, if the cost-cutting goes too deep, the company drowns under the weight of debt it never asked for. The leveraged buyout is only the beginning. Once a private equity firm owns a company, the extraction intensifies through fees. The firm charges the acquired company a management fee, typically 1 to 2% of total assets under management, simply for the privilege of being owned. It charges transaction fees for arranging the deal. It charges monitoring fees for ongoing oversight. It charges advisory fees for strategic guidance. And it charges termination fees when it eventually sells the company and walks away. These fees are not small. In many cases, they amount to tens of millions of dollars per year, money flowing directly from the company's operating budget to the private equity firm's partners. Now consider what this means in practice. A company loaded with debt is also writing checks to the very firm that loaded it with that debt. The firm profits regardless of whether the company thrives or collapses. The fees are contractual. They come first, before employee wages, before reinvestment, before innovation. This is the elegance of the private equity model from the firm's perspective. Risk is transferred downward. Reward is captured upward. And the fee structure ensures that the firm earns money at every stage of the process. During the acquisition, during ownership, and during the exit. There is another mechanism in the playbook, one that is perhaps the most brazen of all. It is called a dividend recapitalization. Here is how it works. After acquiring a company, the private equity firm forces it to take on additional debt, not to invest in growth, not to hire more people, not to build new infrastructure, but to pay a special dividend directly to the firm and its investors. The company borrows money, hands it to its owners, and then must repay that borrowed money from its own future earnings. The owners receive cash immediately. The company absorbs the obligation indefinitely. In some cases, a single dividend recapitalization is enough for the firm to recoup its entire initial investment before the company is even sold. Everything after that is pure profit. This practice accelerated dramatically after the 2008 financial crisis, when interest rates fell to historic lows and borrowing became cheap. Between 2012 and 2019, private equity firms extracted over $200 billion through dividend recapitalizations across the industry. The companies that survived these extractions were weakened. The ones that didn't were left with balance sheets hollowed from the inside, carrying debt that funded nothing but their owners' enrichment. Another chapter in the playbook involves the company's physical assets, specifically its real estate. Many of the companies acquired by private equity own valuable property. Store locations, warehouses, distribution centers, office buildings. These assets sit on the balance sheet, often undervalued. The private equity firm sees an opportunity. It separates the real estate from the operating company, a technique known as a sale-leaseback. The firm sells the company's own properties to a real estate entity, often one controlled by the firm itself. The operating company then leases those properties back, paying rent on buildings it once owned outright. The sale generates an immediate cash windfall, which flows to the firm. But the company now faces a new recurring expense, lease payments, that did not exist before the acquisition. What was once an asset becomes a liability. This is exactly what happened with Mervyn's. The private equity consortium stripped the real estate, collected the proceeds, and left the retailer paying inflated rents on its own former properties. When Mervyn's could no longer sustain those payments alongside its debt obligations, it filed for bankruptcy. The stores closed. The employees lost their jobs. The firm kept the real estate profits. The company was not mismanaged into failure. It was architecturally dismantled. Behind every leveraged buyout, behind every dividend recapitalization, behind every sale leaseback, there are people. And the human cost of private equity ownership is staggering. When costs are slashed, it is workers who are laid off. When benefits are cut, it is employees who lose healthcare coverage. When pension obligations are abandoned, it is retirees who discover their future has been hollowed out. When stores close, it is communities that lose access to essential services. Research from the National Bureau of Economic Research found that private equity buyouts lead to a 10% average reduction in employment at acquired companies within 2 years. Wages stagnate or decline. Job security evaporates. In the healthcare sector, the consequences are particularly devastating. Private equity firms have acquired hundreds of hospitals, nursing homes, and physician practices across the United States. Studies have found that patient outcomes worsen under private equity ownership. Mortality rates increase, staffing levels fall, and the focus shifts from care to cash flow. The paradox is stark. The firms argue that they create value, that they make companies leaner, more efficient, more competitive. But the value they create flows overwhelmingly to investors and partners. The cost is distributed across employees, customers, and communities who had no voice in the transaction and no share in the gains. If you're finding this breakdown valuable, if you want to keep peeling back the layers of the systems that shape the economy most people never see, take a moment to subscribe to this channel. We trace the hidden mechanics of money, debt, and power, the ledgers behind the curtain. Subscribe now so you don't miss what comes next. The private equity firm's ultimate goal is the exit, the moment it sells the company and realizes its returns. And timing that exit is everything. The typical holding period is 3 to 7 years. During that window, the firm has restructured the company, cut costs, paid down some debt, and ideally grown earnings, or at least made the numbers look like growth. The company is then sold through one of 3 channels: a sale to another company, a sale to another private equity firm, or an initial public offering. Each exit path carries its own calculus. A strategic sale to a competitor may fetch the highest price. A secondary buyout, selling to another private equity firm, simply resets the clock and loads the company with a new round of debt. An IPO transfers ownership to public markets, where the firm can gradually sell its shares. But here is the uncomfortable truth. The firm's exit does not mean the company is healthy. It means the firm has captured its return. The debt may still be on the books. The workforce may still be diminished. The real estate may still be leased back at inflated rates. The firm exits. The consequences remain. In many secondary buyouts, the same company passes through the hands of 2 or 3 private equity firms in sequence, each one layering on more debt, extracting more fees, and passing the increasingly fragile business to the next buyer. If there is a single case that captures the entire private equity playbook in one tragic arc, it is Toys R Us. In 2005, a consortium led by Bain Capital, KKR, and Vornado Realty Trust acquired the toy retailer for $6.6 billion. The firms contributed roughly $1.3 billion of their own capital. The remaining $5.3 billion was borrowed and loaded onto the company. Overnight, Toys R Us went from a company with manageable debt to one paying roughly $400 million a year in interest alone. That is $400 million that could not be spent on stores, on inventory, on e-commerce, at the exact moment when Amazon was rewriting the rules of retail. For 12 years, the company staggered under this weight. It attempted to modernize, but every dollar of potential investment was consumed by debt service. Competitors invested in digital infrastructure. Toys R Us could not keep pace. In 2017, the company filed for bankruptcy. Over 30,000 employees lost their jobs. 800 stores closed. Communities across the country lost their local toy store. And the private equity firms? They collected hundreds of millions in fees over the course of ownership. The debt was the company's problem. The profit was the firm's privilege. One might ask, how is any of this allowed? The answer is as simple as it is frustrating. The regulatory framework was never designed to address it. Private equity firms are classified as investment advisors, not banks. They are not subject to the same capital requirements, the same stress tests, the same public disclosure obligations. The companies they acquire are private, which means financial reporting is minimal. The debt they load onto these companies is structured through private credit markets with little oversight. The Securities and Exchange Commission has attempted to increase transparency. In recent years, it proposed rules requiring private equity firms to disclose fees, performance data, and conflicts of interest more clearly. But the industry has pushed back aggressively, arguing that additional regulation would stifle innovation and reduce returns for investors, many of whom are public pension funds managing retirement savings for teachers, firefighters, and government workers. This creates a paradoxical loop. The pension funds of ordinary workers invest in private equity firms that then acquire companies and lay off ordinary workers. The returns generated by those layoffs flow back to the pension fund, but rarely enough to offset the broader economic damage. The regulatory vacuum is not an accident. It is a feature of the system, preserved by lobbying, legal architecture, and the sheer complexity of the structures involved. Private equity is no longer a niche corner of finance. It is a dominant force. As of 2023, private equity firms globally managed over $8 trillion in assets. In the United States alone, private equity-backed companies employ more than 12 million workers. The 5 largest firms, Blackstone, KKR, Apollo, Carlyle, and TPG, collectively control portfolios larger than the economies of most nations. The industry's reach extends into nearly every sector: healthcare, housing, education, retail, media, infrastructure, Private equity firms own emergency medical services, fire and rescue providers, prison phone systems, and childcare centers. They own the veterinary clinics where people bring their pets and the dental practices where they bring their children. This concentration of ownership raises fundamental questions about economic power. When a single firm controls dozens of companies within the same industry, competition erodes, prices rise, quality falls. Workers have fewer employers to choose from, which suppresses wages. The private equity model was originally designed for turnaround situations, rescuing failing companies, injecting expertise and capital, and returning them to health. But the model has evolved. Today, it is applied indiscriminately to profitable companies, to essential services, to industries where failure carries human consequences far beyond a balance sheet. It would be incomplete to tell this story without acknowledging the counter-argument, because the defenders of private equity are neither few nor quiet. The industry argues that private equity creates value, that it takes underperforming companies and makes them more efficient, that it provides capital to businesses that public markets overlook, that its discipline, the pressure of debt, the urgency of a fixed holding period, forces management to make decisions that boards of publicly traded companies defer for decades. And there is data to support some of these claims. Certain studies have shown that private equity-owned companies grow revenue faster than comparable public firms. Some acquisitions do result in genuine operational improvements, streamlined supply chains, modernized technology, better governance. The industry also points to its investors. Pension funds, endowments, and foundations depend on private equity returns to meet their obligations. If private equity underperformed, these institutions would face shortfalls that affect retirees, students, and charitable missions. But the defense rests on an average, and averages conceal enormous variation. For every successful turnaround, there is a Toys R Us. For every company made leaner, there is a hospital where staffing cuts put patients at risk. The question is not whether private equity can create value. It is who captures that value and who absorbs the loss when it is destroyed. Perhaps the most remarkable feature of the private equity playbook is not any single technique. It is the legal architecture that insulates the firms from consequences. Each acquisition is structured through a separate legal entity, a shell company, a special purpose vehicle. If the acquired company fails, the bankruptcy is contained within that entity. The private equity firm's other assets, its other funds, its partner's personal wealth, all remain untouched. The fees that were extracted, already paid. The dividends that were recapitalized, already distributed. The real estate that was stripped, already sold. By the time the company collapses, the money is long gone, legally and irrevocably transferred to the firm and its investors. Creditors can sue. Employees can file claims. But the legal structure is designed to ensure that liability ends at the shell company's door. The firm that orchestrated the strategy bears no obligation to the workers who lost their jobs or the communities that lost their services. This is not a loophole. It is the architecture itself, engineered by the most sophisticated legal minds in finance. refined over decades, and tested in countless bankruptcies. The system works exactly as designed. It is designed to protect the architects. So what is private equity when you strip away the jargon and the legal scaffolding? It is a system that converts other people's risk into its own reward. It borrows against the future of companies it acquires, extracts value in the present, and distributes the consequences to those with the least power to resist: workers, customers, communities, and sometimes entire industries. It is not inherently criminal. It is not always destructive, but the incentive structure is clear. The more aggressively a firm extracts, the higher its returns. And the legal architecture ensures that even when extraction leads to collapse, the firm itself remains insulated. The private equity playbook is not a secret. It is documented in regulatory filings, academic research, and the wreckage of companies that once employed millions. The firms that run this playbook are listed on stock exchanges. Their founders appear on billionaire rankings. Their names adorn university buildings and museum wings. The question is not whether the playbook exists, it is whether we choose to see it, and what we do once we do. If this story clarified something you hadn't fully understood before, consider exploring more of what lies behind the numbers most people never examine. We recently traced another hidden architecture, one that lives inside the banking system itself. That video is waiting for you now.